Hello, I'm Eric Kulwicki, an investment consultant, portfolio manager, and wealth advisor who works with both institutional and retail clients. Now let's get into the second quarter. And before we do, we need to remember what happened in the first quarter because that set up the financial markets for a rebound in the second quarter. Now, if you remember back in late February of this year, that's when the US and Israel launched an attack on Iran. That caused oil prices to spike, more than doubling from their lows when WTI crude went from the low $50 per barrel up to $120 a barrel in March. Equity markets also sold off pretty quickly from their highs, with some areas down over 10%. As things were looking increasingly uncertain and equity markets looked like they might take another leg lower, on April 7th, President Trump that there was a ceasefire with Iran. Now, this announcement caused oil prices to reverse significantly lower from their highs, and equity and credit markets rebounded quickly higher from their lows, and that eventually continued throughout the second quarter. So, a pretty good quarter for equity and credit markets. Now, fast forward today, and nothing's really been fully resolved between the US and Iran, but things really haven't escalated out of control either. It seems like investors have generally assumed the conflict could be somewhat contained, and that's evidenced by WTI crude oil now trading in the low 70s, even after the ceasefire was ended and they're attacking each other again. So, if global energy prices can remain at a manageable level, it could be supportive for global equity and credit markets going forward. Now, if the worst fears of the US Iran conflict is off the table, at least for now, investors have refocused on bullish themes to keep supporting the equity markets. And this leads us to the artificial intelligence trade in the US economy. Investors seem to have significant appetites for anything artificial intelligence related, particularly tied to companies that are in the semiconductor space, memory, and then other areas of the AI infrastructure build out. The demand for AI related stocks in the second quarter helped prepare US equities much higher in the quarter. Although the volatility in the energy markets hasn't been great, really the broader US economy has remained pretty resilient. Corporate fundamentals are relatively strong, with analysts forecasting over 20% year-over-year earnings growth for the S&P 500 index this year, and then continued solid growth in 27. So, in the labor market looks, pretty good as well. So, overall, it's pretty bullish fundamental backdrop for US equities. Now, as a whole, with the potential easing of tensions in the Middle East at some point, bullishness surrounding everything AI, it seems like, and solid U.S. economic and corporate financials doing pretty well, U.S. equities performed well in the second quarter. So for the full quarter, the second quarter, the S&P 500 index rallied about 15%, while the tech-heavy NASDAQ 100 index rallied almost 28%. If you look under the hood, speculative, momentum, high beta stocks performed pretty well in Q2, while other higher quality growth companies with less of an AI narrative surrounding them, they kind of lagged, but still did fine. Small cap stocks in the US and Asian technology stocks in emerging markets also did really well in Q2, as these areas have ties to the AI trade. They also tend to be higher beta and are often tied to speculative trading. So in a strong market in the second quarter, those areas did well. Not really much of a surprise. Inflation has been a bit of a problem, and it's still elevated relative to the Federal Reserve's 2% inflation target. Now remember, inflation is all about supply and demand. Higher demand, less supply leads to higher inflation. If we look at it from a consumer perspective, demand is still pretty good and people still want to buy things even though prices are higher. On the corporate side, there's a ton of demand for capital spending on AI infrastructure, with a race to get as much infrastructure built as quickly as possible. Even some AI related components seem to be in tight supply. So this is pushing prices higher and impacting other industries that need similar technology, hardware components, but are unrelated to AI reasons. And of course, you have the supply shocks in energy from the US Iran conflict, which is keeping energy prices higher. From a numbers perspective, May's personal consumption expenditures, excluding food and energy, jumped 3.4%, and the consumer price index, which does include food and energy prices, jumped 4.2%. So both numbers above the Fed's 2% inflation target, and there really aren't many signs of inflation easing as of yet. Now, if oil prices fall and are sustainably lower, maybe the CPI index can fall from its recent highs. Now that brings us to the Federal Reserve. Kevin Warsh was recently named the new chairman of the Fed. With inflation numbers remaining elevated, Chairman Warsh and other Fed governors have signaled a bit of a hawkish tilt, with indications they want to keep inflation in check. Now, if you remember, at the beginning of the year, investors thought inflation would be trending lower, and markets were actually pricing in multiple Fed rate cuts for this year. Well, as already discussed, the conflict in the Middle East and other factors pushing inflation higher for potentially longer, markets are now pricing in Fed rate hikes, not cuts. So with Fed policy uncertain under new Chairman Warsh, investors should be prepared for potential volatility in the bond market as we go through the rest of the year. Well, Speaking of bonds, bonds were generally higher in the second quarter, led by credit-sensitive bonds, which rebounded from the weakness experienced in the first quarter, kind of like equities did. Interest rates were volatile in the second quarter, often moving with how oil prices traded and the changing inflation expectations that could impact the Federal Reserve's interest rate policy. The level of bond yields remained constructive, so higher yields, higher potential return. So income generation was a good contributor to the total return in bonds for the quarter. Let's look at gold. Gold has been an area that I've discussed in the past, and to me, gold just seems to become more of a speculative, momentum-driven asset rather than a consistent hedge on anything like maybe it had been in the past. Now, looking at last year, gold prices rallied over 60%, which had me concerned that gold became a momentum trade and had gotten too far ahead of itself. Well, that strong momentum did end up reversing pretty quickly this year, with gold falling from a high of around $5,600 an ounce in late January to below $4,000 an ounce in late June. I mean, that's a decline of around 30% in 5 months, which I think is pretty significant, especially for those that consider gold as a conservative asset. If we look at the dollar, the U.S. dollar rallied a little bit this year, maybe for a couple reasons. Part of the rally might have been due to the dollar being thought of as safe haven currency as the U.S.-Iran conflict heated up. Foreign investors looking to get exposure to the U.S. AI trade might be flocking to the U.S., wanting U.S. assets and pushing the dollar higher. And then higher interest rates in the U.S. from rising inflation can attract bond buyers to the U.S. and again, having a need for the dollar. So if these factors continue as they are, the U.S. dollar could continue to find support, but if those factors reverse, the dollar could experience some weakness. Now, if we look to the second half of the year, there's still some cross currents investors need to deal with. The U.S.-Iran situation remains fragile and could create volatility in the markets. There are increased questions regarding the actual return on investments related to the heavy AI spending by companies. So any change in the AI narrative could impact some of the significant gains we've seen in the AI space this year. And then the upcoming U.S. midterm elections in November, that'll probably add some political noise in the markets as well. So in general, I think if the support of economic data and corporate earnings growth can continue, investors who look through some of these short-term uncertainties could continue to be rewarded for the rest of the year. And as always, time will tell. So, all right, that's it. That's it for the second quarter review. Thanks for watching.